Hello and welcome to this Forex Preview at xm.com. I'm Maria Bashardis, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be discussing the Fed's policy announcement on Wednesday and the potential reaction in the US dollar. So Rafi, with virus curbs being tightened across America and Congress still vacillating over the details of a new virus relief package and no concrete deal yet, millions of Americans are worrying whether their unemployment benefits will be cut off at the end of this month. What is the Fed likely to do at this point under the circumstances?
So, Maria, the Fed is really under a lot of pressure for the reasons that you just mentioned there. So, obviously, although we do have vaccines now and the outlook has improved significantly in recent weeks, in the short term, during these winter months, it is going to be a real struggle for many people. And the US recovery is also showing, like in Europe, some signs of slowing down. And there is a small risk of double-dip recession in the US as well. But we really haven't had any strong hints from the Fed that they are considering doing something substantial, such as increasing their asset purchases. What is certain, though, is that the Fed will very likely extend their emergency lending facilities, at least ones that haven't that didn't have the plug pulled on by Secretary of Treasury Steven Mnuchin. And the other likely scenario is that the Fed will probably update their forward guidance, specifically around its bond purchases. And there's two things that the Fed can do as far as the forward guidance is concerned. So they could set out the conditions that the Fed will be looking for that would warrant it to increase or decrease their purchases. So, for example, that would tell the markets that should unemployment start to fall below a certain rate, then that would be a sign that we would start to reduce our asset purchases. The other thing that the Fed can do is to shift their focus towards long-dated bonds. Now, this would be quite significant because such a move could potentially push down treasury yields, specifically on 10-year treasury notes, and that could further pull down the US dollar, which is already under heavy selling pressure.
Okay, so if the Fed reinforces expectations that low rates and yields are here to stay, what reaction can we expect to see in the US dollar?
Well, the dollar has been on quite a long downward slide now. We do have, of course, the improved risk appetite on the back of the improving global growth outlook. So as long as that positive sentiment continues in the markets, the dollar will remain under pressure. But should the Fed make those adjustments to its forward guidance and clearly telegraph the markets that they will be focusing on long-dated bonds, then that could really accelerate the dollar's slide, and we could see an even steeper slump in the greenback. However, anything short of those moves in the forward guidance could spur an upside correction in the US dollar, given how extensively it's been sold so far.
Rafi, thanks so much. And thanks for joining us at xm.com.